Welcome to the Deep Dive. We're here to unpack the essential intelligence you need for navigating Luxembourg's professional world.
Especially if you're in law, finance, corporate governance, or compliance.
Exactly. If you rely on Luxembourg Intelligence News, well, you're in the right place.
Today, we're really digging into the latest Luxembourg Intelligence News Weekly, the mid-May 2025 update specifically.
Our mission: to give you a clear, concise rundown of the key developments impacting your work: financial markets, regulation, funds, corporate law, tax, the works.
Yeah, we're pulling from all the key sources: State Act reports, CSSF and BCL announcements, ESMA consultations, Chamber of Deputies updates, everything that feeds into the news briefing.
Think of this as your curated guide. We'll hit the main takeaways, what they actually mean for you, without drowning you in detail.
All right, let's get started.
Okay, let's kick off with the big picture of the macro environment, some of those regulations that cut across sectors. The economy feels like it's in an interesting spot, doesn't it?
That's a good way to put it. The State Act conjuncture flash for April did mention some global market jitters early that month, commodity prices, equities dipping.
Right.
But interestingly, it looked like the Eurozone and Luxembourg within it was actually holding up a bit better during that patch.
Yeah, and what really jumped out at me, maybe showing Luxembourg's sort of unique position, was that even with that global uncertainty, Luxembourg funds pulled in a record 60 billion euros in net new assets in Q1. 60 billion.
It's huge, isn't it? A 4-year high, according to Statec. It just underlines how attractive Luxembourg still is for funds. That sector is clearly a powerhouse for the economy.
And then you've got the ECB cutting rates, while the U.S. Fed might be tightening. How does that kind of divergence play out for Luxembourg?
Well, the ECB cuts are meant to boost the Eurozone economy, obviously. But if the Fed goes the other way because of different inflation worries, it creates this complex global picture. Luxembourg's financial sector is so international, firms really need to watch how these different paths unfold.
It's funny, though. You have institutions pouring money in, but Statec also showed consumer confidence dipping in March and April, both in Luxembourg and the Eurozone. Seems a bit contradictory.
It is a definite contrast. The consumer dip probably reflects those wider economic anxieties. So you've got strong institutional flows, but maybe more caution from consumers.
Right.
Financial service providers really need to be aware of those potentially different signals in different parts of the market.
Looking forward, the IMF, via Statec, sees Luxembourg's GDP growth bouncing back to about 2% in 2025. What's supposed to drive that?
The projection seems to rely on the private sector picking up, assuming rates stay lower, and the housing market finds its footing again.
Okay. And the immediate stuff, inflation, unemployment.
So Statec put April's annual inflation at 1.7%, up a bit from 1.3% in March. The forecast for the whole year is 1.9%.
Okay.
And unemployment held steady at 5.9% back in January. So you've got this slightly rising inflation alongside the ECB trying to keep things accommodative. It's something to watch.
Definitely. And all this probably means fund prospectuses might need updating on their market outlooks.
Could well do, yeah. Keep those documents current.
Okay, so that's the economic backdrop.
Yeah.
Now let's pivot to regulation, which is moving fast. Starting with AI, looks like the CSSF and DCL have been busy.
They absolutely have. On May 16th, they jointly published their second thematic review on AI use in the financial sector. And the big focus this time, generative AI or Gen AI. They're really drilling down on that.
This is based on a survey, right? Who did they talk to?
Yeah, a wide range: investment firms, fund managers, banks, others. The survey ran mid-last year, June to August 2024.
And they got a good response.
Really good, actually. 86% response rate, which shows the industry is definitely paying attention.
So what did the review look at? What are the key takeaways?
It covered a lot. Firms' AI strategies, how much they're investing, their internal setups for managing AI, different use cases comparing Gen AI with traditional machine learning.
Right.
And crucially, trustworthiness. Things like bias, explainability, can you audit it, who's overseeing it. Plus, they did an initial look at how these AI uses might fit under the new EU AI Act's risk categories.
Ah, the EU AI Act. That's the big one looming. What are the deadlines we need to know about right now?
Okay, so it's phased. Since February 2nd this year, the rules banning unacceptable risk AI are already in force.
Okay.
And importantly, there's this immediate requirement for AI literacy. Basically, people deploying or providing AI need to have a basic understanding of it.
So training staff on AI basics is something firms should be doing like yesterday.
Pretty much, yes.
Oh.
Then, looking ahead, August 2nd this year, 2025 brings rules on authorities, governance, penalties, and importantly, general-purpose AI models, including the systemic ones.
And the main rules for high-risk AI.
Those kick in August 2nd, 2026. Things like detailed documentation, assessments, monitoring, though there's a potential extension to August 2027 for some specific products.
Feels like the CSSF is trying to get the industry ready ahead of time.
Definitely. The review specifically encourages firms to start aligning with the AI Act's principles now. They expect proactive steps on governance and risk management. That AI literacy point really underscores the urgency.
What does this mean for documents? Internal policies, client stuff?
Oh, it's significant internally.
Yeah.
New or updated policies on AI governance, usage, risk, data, plus training plans for AI literacy and keeping an inventory of AI systems and their risks.
Right.
Client-facing terms, privacy notices might need tweaks if AI is involved. And if you're providing GPAI or using high-risk AI, loads more documentation, technical specs, training data info, copyright compliance, impact assessments, cybersecurity, human oversight proof, conformity documents. It's a big list.
Okay, a lot to digest on AI. Let's switch to another big digital piece. DORA, the Digital Operational Resilience Act. That's already live, isn't it?
Yes, applicable since January 17th, 2025. And just recently, May 16th, the CSSF put out a guide on the DORA registers of information.
What's that guide about?
It's quite practical, actually. It focuses on common error messages firms might get when submitting these registers to the European supervisory authorities, the ESAs, and tells them how to fix them.
So helping firms get those crucial registers right. Why are they so important?
These registers give regulators the map of ICT third-party risks across the financial sector. Accurate data helps them spot concentration risks, dependencies on key tech providers. It's vital for oversight.
Makes sense.
The CSSF guide really shows they want quality data. And don't forget, the CAA, the insurance regulator, issued its own DORA circular earlier this year for insurers, including register deadlines. The ESAs are also still working on things like designating critical providers and detailed standards for incident reporting. The general deadline for those first registers was April 30th.
Sounds like DORA is just a submit once and forget thing.
Absolutely not. It's ongoing. New guidance, phased obligations. Firms need to stay engaged and keep adapting their compliance efforts.
And documentation-wise for DORA, what needs adjusting?
Lots again. Internal procedures for keeping that ICT third-party register need to align with the CSSF guidance. The whole ICT risk management framework needs updating for DORA rules. Incident management processes too.
Okay.
And crucially, contracts with ICT third-party providers. They need reviewing and probably amending to meet DORA's tough requirements. The register itself helps prove you've done that, plus aligning internal data collection with the official reporting templates.
Right. Let's move over to investment funds. We mentioned the amazing Q1 inflows. What else is happening in that vital sector?
Well, Staytech's analysis really drives home how central the fund industry is to Luxembourg's economy, value-added, financial service exports, all that. They also see potential for Luxembourg to grab even more of the European ETF market, especially for funds holding U.S. stocks.
What's keeping Luxembourg so attractive?
It seems to be the whole package, right? The ecosystem, regulatory stability, the huge range of products, expert service providers, and maybe some helpful tax tweaks for ETFs coming down the line.
Speaking of regulations, any key EU developments or consultations impacting funds here?
Yes, a couple of important ESMN consultations. One, running from May 2nd to June 20th, is on technical standards for ESG rating providers.
ESG ratings. Very relevant.
Absolutely. For the rating providers, asset managers using them, investors, it looks at methodologies, disclosure of sustainability characteristics.
Okay, and the other one?
That one's on technical standards for the European Green Bond Regulation, the UGBR. It ran from April 7th to May 30th. Very relevant for anyone issuing or investing in bonds labeled as European green bonds.
So the EU is really pushing for more transparency and reliability in sustainable finance.
Definitely. The direction is clear. And these standards will likely mean tougher requirements for funds using ESG ratings or investing in green bonds.
What document changes should funds brace for here?
Prospectuses and offering memoranda will probably need updates on investment policies, especially around ESG integration, use of ratings, and green bond disclosures. Kids will likely need ESG info revised.
Marketing materials too, I guess.
For sure. Any sustainability claims need to be rock solid. Internally, managers need stronger due diligence on ESG raters, compliance procedures for UGBR, and adapting their SFDR and taxonomy reporting.
And finally, for funds, those Luxembourg tax changes, specifically for ETFs.
Right. That's Bill 8414, the Entlastungspack. The proposal, as amended in committee, is to extend the subscription tax exemption to actively managed ETFs.
Okay, actively managed ones.
Yes. That's expected to apply from tax year 2025. The aim is clearly to boost Luxembourg's competitiveness as an ETF hub and pull in more of that active ETF business.
That could make a difference. Documentation impact.
Well, for new actively managed ETFs, prospectuses will reflect the exemption. Existing ones that were taxed might need updates too, and generally the tax sections in fund docs need updating for the broader ETF exemption scope.
Okay, let's shift gears to corporate law, governance, and tax more broadly. What's happening on the corporate governance side in Parliament?
The Chamber's Finance Committee had a draft law on its agenda for May 20th. It's about gender balance targets for boards of listed companies.
Transposing the EU directive.
Exactly. Shows Luxembourg's moving to align with those EU standards and push for more gender diversity on boards.
So listed companies might need to update some key documents.
Potentially, yes. Articles of association might need amendments. Board nomination policies and charters would need to incorporate the targets. Corporate governance statements would need to disclose policies in progress. Annual reports would likely need more detail on board makeup, and HR policies might need updating to support the female talent pipeline.
Now, those tax reforms we touched on, Bill 8414 and 8388, can we unpack Bill 8414, the tax relief package, a bit more?
Sure. Key things in Bill 8414, based on analysis and committee amendments. The CIT rate cut down from 17% to 16% for 2025, and even lower, 14% for profits under $175,000 house.
Right.
The active ETF subscription tax exemption we just mentioned, and significantly clarifications on the interest limitation rules, Article 168 LSLIR. It introduces a definition for a single entity group and might offer group exemptions. That's important for structures like orphan securitization vehicles.
Right.
And finally, a proposed hike in the minimum annual subscription tax for SPFs from €100 up to €1,000.
In Bill 8388, the tax admin modernization one, what's in there?
That one, published last May, adjusts net wealth tax thresholds, clarifies withholding tax exemptions for share class redemption, partial liquidations. It also introduces an option to opt out of the participation exemption regime and updates tax rules for parents with shared custody.
Seems like a strategic push to make Luxembourg more attractive and update the tax system. That interest limitation rule clarification sounds particularly noteworthy.
It really is, especially for those single entity groups like orphan SPVs. It aims to give much needed clarity on interest deductibility, which is fundamental for how they're structured.
So what documents need attention because of all these tax changes?
It's quite a list. Corporate tax filings obviously need the new rates and rules. Financial statements and tax provisions need updating. Intragroup financing deals should be checked against the new 168 bias rules. Securitization documents need reviewing for 168 bias implications.
SBFs too.
Yes, SPF documents and fee structures need adjusting for the higher minimum tax. Shareholder agreements, articles of association might need checking for redemption or participation exemption impacts. And transfer pricing docs might need tweaks due to the CIT rate changes.
Okay, let's look at banking and financial services. There was a recent CJEU Advocate General opinion about the Single Resolution Board's powers. What was that about?
Right, AG Biondi's opinion in the ABLV bank case. It tackled whether the SRB can decide not to put a bank into resolution, even if it's failing or likely to fail and there are no private solutions, specifically when the public interest test for resolution isn't met.
And what did the AG suggest?
The AG proposed dismissing the appeal, basically confirming the SRB does have the power to make that no resolution decision.
Why? What was the reasoning?
The thinking is that deciding whether to resolve falls under the SRB's overall job of handling resolution according to the SRM regulation. And confirming this power gives more legal certainty about when EU resolution kicks in versus national insolvency. And relatedly, the CJEU also dismissed another appeal against the SRB around the same time, basically saying the appellant wasn't directly affected. It just shows how strict the rules are for challenging SRB decisions.
So, if the court follows the AG, it clarifies the SRB's discretion. Any immediate documentation impact for banks?
Not direct mandates, but banks should probably consider it when updating their recovery and resolution plans, the BRRPs. The assessment of that public interest test needs to be realistic about the SRV's discretion.
Okay.
And legal opinions for deals involving bank counterparties might factor this into the risk assessment.
Beyond banking specifically, what other ESMA consultations might affect financial services firms here?
Well, there's one running until June 16th on technical standards for EMIR clearing threshold.
Right, EMI thresholds.
And another one that just closed June 3rd on draft standards for extending the use of the simplified insider list format under MA, the market abuse regulation. It just shows ESMA is constantly fine-tuning the rules.
And changes there mean operational and compliance adjustments, right?
Yeah.
Document updates.
Exactly. For EMAR firms, changes to clearing thresholds could mean updating internal policies, maybe reporting systems. For M-firm firms, if the simplified insider list format is extended, they'll need to update templates, procedures, MR compliance policies, training.
Got it. Let's wrap up with AML-CFT. The CSSF seems very focused here.
Extremely. They held a conference just for investment firms back on March 28th.
What were the key messages?
A few things stood out. The need for distinct RR and RC roles the person responsible for compliance and the person responsible for control, unless you can really justify combining them due to size, and you tell the CSSF.
Okay, clarity on roles.
Yes. Also, one needs to go into the AML-CFT reports, referencing specific CSSF regulations and EBA guidelines, and a big focus on effective transaction monitoring, how alerts are reviewed, the documentation needed. They also reminded firms about the April 4th deadline for updating the 2024 Financial Crime Questionnaire.
And they were planning something similar for banks with the ABBL.
Correct. A joint conference announced for after April 18th, covering 2024 supervision results, and importantly, looking ahead to the new EU AML package.
Seems the CSSF is really emphasizing robust governance, the RRRC separation, and effective monitoring.
That's definitely the takeaway. And that EU AML package mentioned at the banking conference, that's a massive overhaul coming, including the new EU AML Authority, AMLA. Luxembourg firms really need to start preparing for those big changes.
So documentation-wise for AML-CFT, what needs updating?
Internal AML-CFT policies need checking RRC roles, report content, transaction monitoring procedures, incorporating lessons from the 2024 questionnaire, and starting to think about the EU AML package framework.
Risk assessments, too.
Absolutely. Regular updates there, refining customer risk methods. And training materials need to reflect the CSSF's focus areas and prepare staff for the new EU rules.
Okay, nearly there. Just a few other legal and parliamentary bits. A new law on judicial attachés.
Yes, came into force April 6th. It amends the 2012 law, mainly changing the diploma and professional experience requirements.
What are the new requirements?
Now requires at least 2 years of relevant legal experience from the EU, EEA, Switzerland, or UK, public or private sector. Seems aimed at modernizing and widening access to judicial roles. New members were also appointed to the Recruitment Commission back in March.
And what's on the Chamber of Deputies agenda for the coming week?
Looks like a focus on finance and governance. The Finance Committee is looking at the gender balance law again, plus draft laws on income tax and property tax measures. The Budgetary Implementation Committee is reviewing a Court of Auditors report. The Rules Committee is looking at the Transparency Register for lobbyists and deputies' financial interests. And the Justice Committee is discussing changes to the private security law regarding Council of State premises. So lots around finance, transparency, governance.
And finally, any recent laws published in the memorial we should note?
Mostly routine stuff from May 15th, new European standards, non-electrical, electrotechnical, telecoms,
Right.
an ILR regulation on the 2024 electricity mix, and lots of company notices in Memorial B as usual.
So implementing EU standards mainly.
Pretty much.
Yeah.
Standard single market alignment. Businesses dealing with products covered by these new standards just need to make sure their compliance docs, declarations of conformity, technical files, quality systems are up to date.
That was a very thorough run through. It's a lot to track.
Yeah.
We do have a summary of the key upcoming deadlines and changes in the show notes, right?
We do, yes. It pulls together those key dates, SMA consultations, AI Act phases, potential tax changes, DORA milestones, AML focus points, new standards. It's a handy reference.
Great. So wrapping up today's deep dive, we've covered the economic mood, the huge impact of digital finance rules like the AI Act and DORA, updates for funds, corporate governance shifts, tax reforms, banking regulation, and a constant focus on AML-CFT. It's certainly a busy time.
It really is. And what strikes me is how interconnected it all is. Digital innovation drives the need for DORA and AI ethics. Luxembourg's ETF strategy connects directly to tax policy and its global standing. It all fits together.
So the final thought for you, our listener. As Luxembourg keeps navigating this complex world, really getting to grips with how these regulatory and economic pieces fit together is going to be crucial for staying competitive, for staying compliant. So the question is, what proactive steps are you putting in place in your organization to tackle these developments?
Being informed, being prepared, it's absolutely essential now.
Make sure you hit subscribe and like the deep dive so you don't miss our next analysis of Luxembourg Intelligence News.
Luxembourg Intelligence News.